All right, here we go. Let's jump into it, guys. Share. So here we go. We are going to go through two severely undervalued dividend growth stocks today. So these have been up for a huge publicity screening all across many YouTubers, platforms, and whatnot. And these are two holdings that I am going to hold for the very long term. So the first up, we're going to cover Novo Nordisk, ticker symbol NVO. So it's down over the last year, as you can see here, by over 53%, and within the last year, which is crazy. If we look at the revenue growth, we see the revenue year over year is up almost 24%, and the net income's up 45%. We look at their forward PE as a 2.1 on a forward-looking guidance, as well as the earnings per share is over 24. Their starting dividend yield is a 3.44, gives them an annual payout of $1.73. This one is it pays twice a year since it's a European stock. The payout here is saying about 83%, but if we actually look on sources online here, and we even go here, stock forward payout ratio. Butchered that a little bit, just so you guys can see what I'm saying too. I sometimes like to use Google better than Bing, honestly, because if I pull it up here, it's sometimes not always the best. Yeah, that's why I don't really care for using I don't really care for using Bing as much. I like Google currently. So if I put that in, so right here, the forward payout ratio is actually around 49 to 50%, which is what I was going to tell you guys, but I wanted to actually show you guys so you could see it on the screen in real time. So having said that, it's a lot healthier than that, actually. So very sustainable. Now let's get into them a little bit. First, before we dissect them and go over some metrics, I want to kind of go over the long-time annualized return and what we're seeing between analysts' projections long-term, Microsoft, and Google, and what they're saying. So they pull these from multiple websites. This is AI. So basically, it goes over the historical reference. So a historical reference point, by the way, their 20-year historical return has been over 22%, and that's total return. So dividends reinvested. So that's annualized, which is huge. And some numbers I've looked at, it's actually a little closer to like 16 to 17.5% for the 20-year annualized returns. However, it's still phenomenal, way outbeats the market. And then now looking forward are their forward price projections. These are basically assuming dividend reinvestment and for total annualized return. So by 2030, the approximate CAGR year over year could be around 16.4%. If we fast forward that up to 2040, 19%. And these are annualized returns. So you see the price movement is substantial. 2050, you're at almost 1,700% return for a compound annual growth of 14.5%. And then the scenarios behind this methodology is this. So bullish scenario, they have a successful GLP-1 drug expansion pipeline. The CAGR can range from 16 to 22% from 2025, so now to 2050. A baseline scenario, basically they moderate or they stabilize their growth and remain competitive. That CAGR alone would normalize to about a 12 to 15% annualized. Excuse me. It's still sick, or at least congested. So then let's look at the bearish case. So basically the downside. So basically they could have, this is assuming that they have regulatory or market setbacks, tariff impacts, which they've already actually overcome the tariffs by making an agreement with Trump. And they have a tariff exemption for like 5 years. I'm sure that could be extended if there's even tariffs by then anyways. And because of manufacturing in the US as well. And then just competition that's always going to exist with any business. But in reality, the true businesses and the ones that aren't pirating other people's stuff is probably going to win out long term. CAGR, so it would be below 10%. So that's like the bearish case scenario. So bearish case, you're going to be a little below the market, but it stabilizes. You're returning, 2 to 5% above market annualized return. Bullish case, you're returning maybe almost double. So that's pretty amazing. And here it is right here, projected EPS period. So 2025 to 2030, bullish case about 16.4% annualized. Just a base case about 14%. And then we can see if we go out further, it'd be much higher. So in conclusion, there's just a lot of different estimates out there. So we don't know fully, right? But if we look on analysts here, where they pull this from different analysts too on Google, they say long-term annualized returns will be in the range of 6 to over 25%, with many sources converging around the 11 to 14%, depending on market conditions and competitive factors. So their mid-case scenario, again, is around the 11 to 14% annualized return, right in that ballpark. So that'd be a 12% annual return for long-term investors. Their bullish case is 17 to 25% annual return. So that'd be that would be huge. That's double the market return and then some on the high bullish case. Bearish case is around 6% annualized return or lower. And so their bearish case is a little less even. However, remember, you're getting almost a 3.5% starting dividend yield. And that dividend, which we'll look at, has grown at over 20% in the last 5 years and has had phenomenal dividend growth over the long term too. So just be aware of that. Just alone, you're getting that besides any price appreciation. So now what I want to do, now that you guys kind of see the projections and everything, basically it'll come down to the pipeline success, how they perform in the GLP-1 dominance market. So overall, globally, they make up like 50 to 60% of the GLP-1 market. So it'll be key for them to maintain that and continue to innovate. They also do rare diseases and some other stuff too. They've been doing some cost-cutting initiatives as well. So that'll be interesting to see how that plays out. So now going just through the stock, because we don't want to look at that just in isolation. Let's look through here. So first thing, dividends. We want to see that. So we know that payout is skewed higher here on this website. It's actually more like 50% forward P. However, the dividend growth has been over the last 5 years, 21.57%. That's huge. Their 1 year was almost 20%. You can see what this looks like on a charted out as well. You can go all time. You can see they had some special payouts, but it's been a nice trend up, really, if we look, especially in recent years as well with the GLP-1 market. Let's look at their dividend yield over a long period too. So over a 10-year, their average yield is set around a 2.05% over assuming even these high dividends. So in reality, the actual has been closer to that 1 or sub 1% if we look past here in this trend line here and past over here, just over 1%, under 2%. So today we're buying them at a 3.4, so it's a high. It hasn't been that high of a yield since, if we go back here, right here, August of 2018. So that's something to also look at for valuation. Never look at it in isolation, but look at it. Net income, they have really good net income, as you can see. Their total revenue in the last trailing 12 months has been $312 billion. Their net income is $111. So they have really good net margins. So if you look at their operating margin, it's like it's been like 55% or so, somewhere in there. And then their net is, a little below that, but you're getting a net operating income of 30s to 40s. I mean, that's huge for an established business. That's really good. And that reminds me of Visa or MasterCard. Not quite the equivalent, but super good. So what I like to look at here, I like to see their net income trend upward in a positive, healthy manner over time, as you can see it has. I also like to see the balance sheet I like to look at the total assets, of course, and see how that's growing and outpacing the liabilities. But then I also like to look here at the shares outstanding. So I like to see in most established businesses, unless it's a utility stock where they issue shares like NEE, for example, and certain other businesses, and that's kind of the normal theme. Without getting too much dilution, the most part, I like to see businesses buying back shares to be able to actually increase our ownership of the business over time. Now, obviously not do that in isolation, doing dividend growth. That's going to be key because a lot of businesses buy back shares at the wrong time when they're high. Excuse me. Yep, you can tell I'm sick. You have to excuse me for that. So this is the down and dirty, the real. So anyways, as you can see, back in 2015, this is how many shares outstanding they had in millions. Now they have reduced it all the way to that. So that's a huge drop. So year over year, we like to see that a lot. And the enterprise has gone up in value, even though it's recently dropped in near term, because obviously the share price has dropped. We like to see, we've checked cash flow. Free cash flow is a good metric too. That's grown at a good steady rate to exceed dividends paid. And like I said, some of these numbers, looks to me, can be a little skewed. Trailing 12 months, it's actually not that high for dividends paid because we know that they didn't pay out more dividends than they've earned. But there you go again, free cash flow. And free cash flow can be skewed too, because that can also include other things and depreciations and whatnot. And after everything is settled out, we look at their PE though. You see this trend line here over the long term. It's been much higher than it has over the last trailing 12 months. And if we look on a forward guidance, we were like at a 2. So it's very, very cheap looking at that too. And then we want to look at revenue per share. That's exploded over the last decade, as you can see. We want to look at their price to sales. See, that has also trended down. So we're buying them at a super cheap price to sales. And then same thing, we want to look at the, what our return on assets and equity capital invested seen as a measure of how efficient the company is for investing the money to be able to get a return. So as you can see here, all of those are in very, very solid digit returns. As you can see, trailing 12 months has still been return on capital invested almost 58%. Return on equity is over 71, and ROI, same thing. That's over 23%. I mean, these are phenomenal numbers from an established business, really. I mean, you can't hardly ask for better when it comes to that. So I like what I see. I think it's pretty interesting. And that's why I hold so much of them. I hold a very, very large percentage of them. If we look down here, I hold over about 806 shares. So I'm actually down on my position because I started buying when they're higher. So long term, though, it should be pretty nice. All right, so next one, let's go into United, UNH. Let's look at that. So before we look into it in total isolation, see their 1 year, they're down over 34%. And if we actually went from when they had a large drop in April of 25 here, and it just spiraled downward, it could actually be down a little more than that. But they've been up recently as well, and so that's why it's a little skewed. Let's see what they have to say too for the long-term return. Let's do that. Let's do, I think you guys are going to like what you see here as well. And then the forward payout ratio on them, I always like to use multiple sources here. So right here, that's 45% basically, forward PE, which is pretty good with all the increased costs they've had over the last year, really, a few years. So now some of these numbers, of course, they can be kind of skewed, obviously. But let's see if they even, yeah, so they don't even have anything here for Bing. Sometimes, like I said, I don't like using them as much, always. But here we go. Here they actually do have something, which is kind of nice. So, all right, historical total return. So it goes off of historically. So their historical 20-year CAGR, and this is with being down so much, has been about 10%. So about market. 15 years been 17 and over a quarter. That's huge. And then dividends reinvested here. So generally, though, over the last 10 years, they've delivered a 13% CAGR. Now, long-term projections. So average projected price is this. If we go to a bull case scenario, which I don't even personally think it's a bull case, that's in my humble opinion, but they're saying about a 15% annualized return over the next 5 years. The average analyst target mid case is just mid case is a 4.4% annualized, which is not that good. Now we're going to look at some other numbers and see kind of what it is, though. So just currently, though, the dividend, as you guys can see here, is about a 2.6 starting dividend yield with pretty good growth. So that alone is almost a 3% return, over 2.5 just in the dividend. So the mid case total CAGR, including dividends, is 6 to 7. Bullish case is 17%. Okay, so having said that, let's kind of go to this. So if we go up to a historical, we're looking at a 13%. So if we go to just a mid case, that's basically assuming that things are not recovering, and it's just mid case stays where it is. 67% with divvies. Bull case, you're looking at almost 18%. So I think we're going to be somewhere closer to the bull case. So here we go. Let's see what analysts over here say as well. So basically, general consensus is between 8 to 18% annualized returns, suggesting 14% annually for the next few years. Basically assuming, these basically are assuming higher medical input costs, regulatory pressures, and also assuming the recovery as well for the long-term earnings target of 13 to 16%. So total returns, long-term, they're projecting an 8 to 12% annualized return. And then 14% annualized return by 2027. 17% by 2027 is suggesting, basically growth comes back and they're able to kind of reestablish. And then even the higher growth rates of about 18% is saying that, hey, they're going to return back to where they were and be able to continue that trend of growth as well. So I think this is probably more realistic. Past is not a guarantee, but they have some headwinds and some things to work out. But at the same time, they are a behemoth of a giant. And, they're already working on this, and it's already shown. And same thing with the DOJ case as well. It's not actually gone anywhere in like a terrible direction. It's more so, hey, how can we make the system more efficient and prevent issues for people as well? So that way, people are getting treatment. And, like I said, with any insurance company, they're all skewed in ways because, they have to keep costs down so that way they can be a profitable business, whether we agree or not. I don't like that, but it's the reality of the situation. You own a business, you have to make money. So their net margins are pretty low overall because they have just a lot of volume. So if we go back here, look at through the stock, that's trading at just over $341.84. Starting dividend yield of almost 2.6. Their forward price to earnings is 19.4. Their current is just under 18. Like I said, their payout is around 45%. This is about 36.5. It's showing dividend growth. Let's look at that. This is pretty phenomenal. Slowed down. Even with all this happening, they still did over 6%. Excuse me. It's actually not as high as that. It was just over 5%. I was remembering when that happened too. So even with all the issues they had going on, but historically speaking, their 5-year has been over 12.5%, and they've maintained a good dividend growth streak over many, many years. If we look at them on a 10-year, we see in 2015 they paid $1.87.5. 2025 is not even finished, and that's at $8.73. So that's a huge growth. If we look at the average here and what you could have bought them for in the past, you see I was buying them in this whole range right here where they're over 3%. So my yield on cost is pretty good. But I also got in when I was buying them when it was lower. So I was buying them on the trend line as it was still up and going down. This is why I say don't time the market, guys, just average in. Having said that, as you can see, you're still buying them at a historical high starting dividend yield because the average has been under 1.5% as we're looking back in time. All right, so financials. As you can see, the net income it's hilarious because it's tiny, and that you're going to see a revolving theme between them and other insurance companies. That's normal. It's kind of like grocery stocks. Kroger is super low. They have high volumes and low net income. So total revenue, as you can see, trailing 12 months, it's been over almost 423 million. So it's, like I said, it's a lot different. The gross profits, though, as you can see here, trailing 12 months, what we're looking at. So net income here, and these are all in millions of dollars as well. So I may have skewed what I said there a moment ago, but net income, as you can see, way, way lower than that overall gross. And that's to be expected. But the trend line of the net income is growing up at a nice, good clip. So I like to see that. Let's look at the balance sheet. So here's our long-term debt. And then we also have our, total assets has grown at a good rate. So that's a good sign to exceed our debt. And then shares outstanding, I like to see that. So the enterprise is growing at a good rate too, even with being down in recent time. Obviously, share price is down too. So shares outstanding, though, they bought back at a decent clip, really. So that's a good sign they're not diluting shareholders. Get into cash flow. As you can see, free cash flow is increased at a really good, healthy rate to be able to, sustain the dividends, as you can see here. Now let's go to some stats. So their price to earnings, historically speaking, has been a lot higher, in the high teens to mid 20s, even into the 30s, and the trailing 12 months has been under 15. And we know that their forward PE is about a 19. Payout ratios were about a 45%. So a little higher than some of the trend line in the past, but that makes sense because of rising costs. Revenue per share has gone up good. Price to sales. So you can see for the majority over the last decade, we're buying them at a discount here on a price to sales. All right, and then we want to look at their, debt to equity. How much debt do they have? It's lower, below 1 here, so that's a good sign. I like to see they're not levered up way too much. And then their return on assets, return on equity, return on capital invested, as you can see here, has been fairly solid. It's not as high as Novo, but it's definitely a compelling look for sure for an insurance company. So if we can just attain and get back to a normalized price and normalized growth, this one here, we're probably going to have a 14+% annualized growth return or more for the next decade, from current levels and maybe even higher. Obviously, we can't look at that as just like, only, like I said, we went over the downside and everything else. The main downside is just more regulatory issues or other issues that affects the business, the input costs, but they've already raised costs and everything. And that's normal for any business. They're going to raise the costs so that way they can keep the doors open. It's terrible for the consumer, for us. I don't like it either, but it's the reality of our inflationary environment. So that being said, there was 2 awesome stocks for long term. Yeah, and they should do pretty well. I hope you guys enjoyed that analysis. We kind of went through, and I gathered it from many analysts. And United Health and Novo Nordisk, they'll be really awesome long-term growth drivers. So if you choose to add them to your portfolio, consider it. And I'll see you guys on the next one. Till next time.